He's doing it again. After spending $4.5 billion last week to buy 91.2 million shares of Occidental, on Friday, Buffett spent another $1.5 billion to add another 27.1 million shares at an average price between $51 and $58. G'day guys, I'm talking about Warren Buffett and his continued purchase of shares in Occidental. And in this week's Money Market Update, we're not only going to touch on what Buffett's been doing, but why is Amazon rising and why did it rise 8% in the last week? Why are some investment banks, Goldman Sachs in particular, pricing in the potential for a US recession? Our latest trading tip, and when are share prices going to stop falling? It's been 5 weeks in a row. Stick around because this is your Money Market Update. So last week I said that inflation was going to be the big number the market was going to watch, and that's exactly what they did on Thursday. We're going to get to that inflation number in a moment, but two of the big headlines last week was one about Berkshire Hathaway and the other one about Amazon. Berkshire Hathaway has been buying a bigger and bigger stake in one of the world's biggest oil businesses. In fact, Occidental is 102 years old. Warren Buffett lent Occidental $10 billion a few years ago when it was looking to take over and went into a bidding war with Chevron and some other oil businesses for a rival oil business called Anadarko. Now, Oxy took on a huge amount of debt, $55 billion, and Warren Buffett was essentially the lender of last resort. They needed $10 billion to make this deal happen. And the market didn't like the fact that Oxy was getting into this bidding war with Chevron and other oil businesses to buy Anadarko. Long story short, the share price sunk to $37. Of course, along comes the pandemic in early 2020. Oil prices get crushed, and for a very short period of time, oil prices were essentially zero. Oxy's share price went to $9. Now, myself and my clients are looking around and I'm analyzing, saying, hey, there's got to be some oil businesses, some energy businesses that are going to thrive on the other side of the pandemic because there's going to be economic output boom everywhere. We came across Oxy and I discovered that Buffett was part of this deal. Now, my thesis is that Warren Buffett is not going to lend $10 billion, no matter how much interest he's getting, to a business that is likely going to go belly up. And as it's turned out, Warren Buffett is clearly of the view that Occidental has a very bright future because he's now buying shares, right now, tens of millions of them, for a share price between $50 and $60 right now. We were fortunate enough to invest in Occidental back in December 2020 when the share price was $15.20. Now, we've added to our position a couple of times, but basically we've made more than 3 times our money on that deal. So that was one of the big news items last week, and many of our clients here at Trading Mastery have been enjoying that news because for us to buy it at $15.20 and Warren Buffett to think it's a great deal at $50, between $50 and $60, just goes to show when you put in the due diligence and you make the investment, you get the reward. So that was one piece of big news last week. And of course, this will hit the press as well on Monday that Buffett's continuing to buy more shares in Occidental, and I suggest that the share price will probably continue to rise higher because everybody wants to own what Warren Buffett owns. Now, the second big news item was the week was Amazon. Amazon's share price has basically been doing nothing for the past 12 to 18 months. It's been ranging up and down. But Amazon came out with some news this week that it's going to have a 20-to-1 stock split, and it's going to start to use the billions and billions of dollars that it's got in cash and start to have a share buyback program, which is really great news for loyal investors. That in a moment. Back to the stock split, 20-to-1 stock split. It's important to remember when businesses have stock splits, nobody gets anything for free. But clearly Amazon's share price around $3,000 is a little bit out of the reach of many investors to buy a handful of shares. So what Amazon have done, as many businesses like Apple and Tesla and lots of other businesses did in 2020 and 2021, they split their stock. Alphabet just announced they're going to be splitting their stock 20-to-1 in the coming months. I think it happens in June. But Amazon 20-to-1 stock split based on the current price right now basically means that investors would be able to buy the shares today at around $150. So what this is going to mean means Amazon is going to become a much more attractive company to own shares in for the average investor who can't afford to buy a handful of shares at $3,000. Now, here's the other thing as well. It does give Amazon the ability, now that the share price is going to be between, say, 150 and probably 160, roughly around there, to actually reward some of its loyal employees with some shares. Amazon's pretty reluctant to give out shares to its employees when they're $3,000 a share. But if you work for Amazon, now that the share price is going to be 150, 160, we might find that Amazon starts to reward some of their employees with some shares. So we're going to keep an eye on that. Bottom line, it's going to be a lot cheaper. Nobody gets anything for free, and companies do this purely to make the share price more attractive. And I think with the new CEO that have taken over from Jeff Bezos, this could be Amazon's leading management team deciding we want to get this share price moving. The share price was up 8% just last week. We've owned it for the last 18 months, so that's been a real positive. Now, the other news this week, of course, was the inflation number, 7.9% in the United States. That simply means that the average price of things is going up close to 8% year on year. This cannot continue for the next 12 to 18 months. Americans have $2.6 trillion in excess savings right now. They can afford higher prices for the next 6 to 9 months. I don't have any problems with that. But the bottom line is, if inflation stays high for an extended period of time, Goldman Sachs and other big investment banks right now are pricing into the market that the US could see a recession, about a 35% chance of that happening right now. Now, the longer inflation stays high, the probability is the US would go into a recession. If inflation stayed high around 8% for the next 12 months, oil prices remained above $100 a barrel, then the probability would be better than 50-50. But we don't have a better than 50-50 probability yet. However, I think in the back half of this year is when inflation might start to drift lower. So essentially the major theme in the market last week from an economic data perspective was all around inflation, and that is going to drag through to the coming weeks ahead. Amazon, Berkshire Hathaway, they were really the two company big news last week. And then of course we've got the tragedy that is happening in Ukraine. That is dragging on market sentiment. But here's what I think is going to happen. I think we're likely in the coming weeks ahead going to see this fade. History will show that so long as this doesn't spread outside of Ukraine, the probability is what's going on in Ukraine and how that impacts the market from a sentiment perspective is likely going to fade somewhat. So we're going to touch on the upcoming economic calendar shortly, but I want to share with you a trading tip today, which I think is going to help those of you that are thinking about your retirement, thinking about how much money can I compound in the years ahead. I go duck over and make a cup of tea. I want to share with you what is called the Rule of 72. So, the Rule of 72, have you ever heard of it? So do you want to know, based on your return on investment, how long it's going to take for you to double your money? So everybody wants to know how much money they can make. Well, you're going to work out some numbers too. So the Rule of 72 simply goes like this. Think about the return on investment that you think that you can genuinely achieve each year for the next 5, 10, 15, 20 years. So compounding money is about three things. One, it's about how much money you've got. What's the return on investment, and what's the runway, the length of time? So for example, if you thought that you could achieve an 18% return on investment, okay, you could average that over the course of the next 20 years, for example. That's a pretty decent return given the S&P is about 10. But 18, so divide 72 into 18. That's all you got to do. 72 divided by 18. And I'll give you an example. So using the calculator here, if we just go 72 divided by 18 is going to give us 4. Okay, so that basically means every 4 years you would double your money. So let's assume that you're 45 years of age, you want to retire at 65, so you've got 20 years. So that means you're going to get essentially over that time 5 doubles. Now if you started with $100,000 and you go 100,000 times 2 times 2 times 2 times 2 times 2, you're going to get $3.2 million. So essentially the rule of 72 is a wonderful way for you to work out if it was say 15%, then you're roughly going to double your money every 4.8 years. So if you want to actually really genuinely build wealth, you have to be of the mindset of a compounding investor. And learning about these numbers, the rule of 72, and working out realistic figures of based on your previous performance and whatever you're doing going forward. I mean, my return on investment for the last 10 years has been around about 23% on average. I don't expect that to be 23% going forward for the next 10 years. It may be 15, it might be 18. There might be a few years that it might be higher or lower. The last 2 years combined together was 89.88%. But use that rule of thumb, the rule of 72, and work out in your investing lifetime how many doubles you're going to get. And what you'll find is the compounding effect is extraordinary. All right, so everyone wants to know when a share price is going to stop falling. 5 weeks in a row, we've seen the S&P, the NASDAQ, and the Dow Jones down quite sharply. The NASDAQ is down well over 20%. The S&P is down about 13, 14%. We've seen some really strong rallies in this general downtrend. But the bottom line is, guys, is when you have the biggest geopolitical event since 1945, and you've also got on the back of that inflation about 8% in the US, you're going to see volatility. Now, as I said before, I think over time what's going on in Ukraine is likely going to fade with respect to what financial markets view of that event. The reason being is because what's happening in Ukraine isn't going to impact in a big way a lot of the businesses listed on the New York Stock Exchange, the NASDAQ, or even here in Australia on the ASX 200. Definitely in Europe, they're going to see a recession. Russia's going to see a depression, and there are going to be tough times in Europe. But we don't own businesses in that sector of the world. We own businesses here in Australia and in the US. So how long is this volatility going to last? I think the volatility will last for another few weeks, maybe even another month or two. But you can't sit on the sidelines and go, well, I'll wait until the volatility's over before I actually put money to work, because you're going to miss all of the wonderful businesses that have seen their share prices fall sharply in the last few weeks and months and that are down between 20 and 30%. I'm buying on Monday every core business in my portfolio. I'm adding to positions in those companies, every one of them. So I think the volatility will likely continue for a little while, but what is likely going to happen in the future is these great quality companies will thrive and we will do very nicely. So, but you can't afford to sit on the sidelines and procrastinate. Now, economic calendar this week. What's coming up? And there's one particular item coming up this week that is not being spoken about in the news yet, at least. Now, on Wednesday, we're going to see the latest US retail sales. That'll be important for the very short term. Are US consumers continuing to spend money? I think they will be. US Fed decision on Thursday. Market already knows they're going to put interest rates up at least 0.25%. Will they put them up 0.5%? I don't think so. But that will be the big number this week from an economic data perspective. Aussie unemployment data on Thursday. Market expects 4.1%. Not going to impact our portfolio at all in any big way, but it'll be important for the Australian economy. Bank of England interest rate decision also on Thursday. They've already put interest rates up recently. They're likely to put rates up again. Market expects 0.75% now. And Japan inflation on Friday. Can you believe it? The rest of the world is seeing inflation rally strongly. What's inflation in Japan? 0.5%. So the economic data economic data calendar is busy this week. Thursday's a big day, particularly with that US Fed rate decision. But there's going to be something I'm going to keep my eye on that could impact financial markets in the short to medium term. And that is that Russia has to pay a significant amount of interest in the next 10 days on some debt. I'm betting that Russia is going to default on its debt in the coming weeks and months ahead. How that plays out in the markets from a sentiment perspective, we're not really sure. To be quite frank, I don't really care because it doesn't impact my portfolio. But I want you to know, as an investor, what drives sentiment and prices higher. Earnings of companies drive prices higher. No earnings, no money in the bank, difficult times, share prices go lower, and the share prices of companies that don't make any money sink. But this week's another busy week. I wish you every success. If you'd like to come across and learn how to build a trading mastery portfolio of great quality companies, this is how much money I've made in the last 2 years. And you can have an opportunity of owning the same business as I do. And I'm more than happy to help you build your own portfolio to make sure the years ahead are built with meaningful returns, long term and not short term. I'll see you next week.